So let's quickly see the major amendment that has been made for this syllabus, which is the introduction of the new capital allowance. So let's have a quick look and understand the same. This is the new amendment, which is enhanced capital allowances for companies only for a 2-year period from 1st April 21 till 31st March 23. Companies can benefit from enhanced capital allowances when they purchase a new plant and machinery. Please understand this term very carefully. It is not just any or second-hand plant and machinery. It's a completely new plant and machinery. And again, the asset defined is only plant and machinery, not cars or any other asset category. Right? So whenever there is a new purchase of plant and machinery, then only the companies are entitled for an enhanced capital allowance in addition to the capital allowances that they normally receive. Okay, what do we mean by this? That any expenses that belong to the main pool, there is a 130% super deduction, which means that for every 100 of expenses, a first year allowance of 130 is available. Again, it is like a first year allowance. It is only available in the first year of the purchase of the new machinery. In case if the expenditure belongs to a special rate pool item, then there is a 50% first year allowance. For expenses falling into the main pool, there's 130% super deduction should be claimed rather than 100% annual investment allowance. However, for expenses which are falling into the special rate pool, the 100% AIA should be claimed in preference to the 50% FYA. That means you can only claim in this with respect to this machinery, this new machinery purchased. Either you will claim the first year allowance or the AIA, which is more useful. Of course, for the main pool, AIA is not useful as compared to the first year allowance because here we are getting 130% of the expenditure. And for AIA, we receive only 100% of the expenditure. For a special rate pool, definitely it is more benefitable to go for AIA because there we get 100% of the expenses as allowances. But under the new rule, we only get 50% as the allowance. Of course, if there is no AIA remaining, then this first allowances are always beneficial to be taken, not to be left behind. Enhanced capital allowances are not available to sole traders or partnerships, only to the companies it is available. And only the expenditure on the new plant and machinery qualifies and not the expenditure on the second-hand assets. I hope I made myself very, very clear. Motor cars do not qualify. A question, now important guys, focus, your exam tip, this is what we are waiting for. A question will not be set in exams in the period June 22 to March 23 involving the disposal on the plant and machinery on which there is enhanced capital allowances have been claimed or where enhanced capital allowance expenditures incurred in an accounting period till 31st March 23. So definitely for all you guys, disposal is right now not covered. When it will be covered, we'll have detailed instructions on the same as well. I hope this point is absolutely clear. So guys, don't forget this sitting for June 22. Remember that there is an enhanced capital allowance also for companies. Okay, let's quickly look at the other changes. Right, so chapter 19, we have discussed the changes. Chapter 20, chargeable gain for companies, there is no change at all. There is a small change in the corporation tax. Let me just show you that. So very small, tiny change. The rates are not changed, they're as it is. However, there is a rate change from for tax year 21-22, but that's not applicable for you. Okay, again, just like individuals, a trading loss can be normally carried back and set against total profits of the preceding 12 months. We have read it. For loss-making accounting periods which are ending between April 20 to March 22, 2 years, the relief, the loss relief is not extended to only, it's not 1 year, it's not 12 months. For these 2 years, the loss relief is not 1 year, it is extended to 3 years. This means you can carry back your loss for the 3 years, 36 months. But for exam purposes, this additional loss relief is not examinable, though this effect has been made, but for these terms, it is not examinable. So please keep this in mind. Just do not use it in the exam, because this is, excuse me, because this is not examinable. So definitely you're not going to be examined on the same. Okay, now the next one. So chargeable gain for companies, there is no change. Loss relief for single companies, we've discussed. Apart from this, no change. Groups, no change. Self-assessment and payment of taxes by the companies, absolutely no change. So let me just have a quick look to understand whether we have covered all the changes or not for the companies. Yeah. Okay. So believing this, there is no change. Now let's come to VAT, the last portions, to understand the changes. So now we are on VAT, and quickly let's have a look at the changes. Right. Everything is same, rate of interest, everything is same, your registration criteria, deregistration criteria, VAT rates, everything is absolutely same as to what you have studied till March 22. The only thing is, number one, the only difference is that we can list out is, number one, what we have been studying till now is UK and EU. UK and EU, we take it together, right? UK and European countries. So if a supplier is selling goods from European Union to UK, the people, whenever we used to consider this transaction, we did never looked at it as an import, because import was supposed to mean that is up after EU, like import was something that was coming outside of EU. But this thing has been changed, amended, and more clarified. The same VAT treatment now applies to all import of goods, whether they are from EU or from outside the EU, the same rule will be applicable. So whether you are taking it, you are getting the imports from EU country or from Asia, another Asian country, it will be treated in the same way. Another thing, another concept is a system of postponed accounting. Guys, how do we do imports accounting, or how do we do the VAT transactions for imports? As soon as an import has happened, when the next return it is becoming due, we take this import under the VAT outwards, right? And we pay VAT output VAT to the government, and in return we claim input VAT in turn. It's a nil effect. There is no profit, no loss, no VAT payments, no VAT repayments in the hands of the supplier or the assessee, whoever is the taxpayer. Okay, whoever is the taxpayer. So now comes one more point, that what is this accounting known as? This accounting is known as postponed VAT accounting. Okay, why it is called as a postponed VAT accounting? Because VAT is not paid at the time of importation, but it is paid at the time of return. So it is postponed till return, therefore it is called as postponed accounting. Okay, now for your exam purposes, different rules apply for okay. As far as your UK tax is concerned, and for exam purposes also, it should be assumed that postponed accounting applies to all import of goods, and there are no goods for which you're going to pay taxes at the time of importation. For exam purposes, please remember that all goods, all imports are covered under the postponed accounting only. One more change, or one more understanding is there. The different rule apply for the imported goods with a value below 135 pounds, but these are not examinable in your exam. Okay, that's all. This is the entire summary over the changes that have been made for your March 22 to June 22 attempt. I hope that you guys are preparing very well and absolutely great. You're going to clear the exam soon. And if you have any queries, any doubts, please drop it in the comments below. Okay, and I shall be replying to it. Thank you so much. Take care. Bye-bye.